Yes, people. So let's get started with the next topic, which is cost of capital. We will do chapter number 2 and 3 also. Chapter number 2 is theory. We'll take it a little later. Chapter number 3 is a totally unrelated topic. We can take whenever we want. So I will decide when to do. So for now, we will start with chapter number 4, cost of capital. Important topics. So a lot of questions have been coming from. In fact, you have hardly any 7-8 topics. So all of them are kind of important in FM. And about the weightage, people, currently, or the way the weightage structure is devised by ICAI, they are not giving chapter wise weightage. Okay. They are giving it section wise. Like chapter 1, chapter 2, okay, put together comes for like 5 to 7%, like that. So like this chapter 4, 5 and 6 constitutes about 50% of your paper. So like that. So that the weightage they have given, because they don't want any student to skip any chapter entirely. Because if they give, ICAI gives weightage saying that cost of capital comes 5%, then some student may say, okay, 50 ka 5% is 2.5 marks. So that means roughly 3 marks. I'll skip it. So ICAI maybe doesn't want the students to take those decisions. That's the reason they have clubbed many topics and accordingly weightage is given. So you don't have any option to skip all the topics. So probably that's the emphasis on the new scheme. So if you skip any topic, you are taking a bigger risk. Okay. So I will share that weightage with you. For the recorded, guys, it will be put up on the ArivuPro under course itself, under your study material or resource section itself. I'll put up that recommended order file, notes file, as well as the weightage file. For you guys, I'll ask the team to share it with you along with the notes. Fine. It's already shared for advanced accounting. It's one file which has weightage for all the 6 papers of advanced account or intermediate. I think even final and foundation ka weights also is in the same file. Any which way, I'll ask the team to share it again. Super. So now let's get started with this topic, which is cost of capital. Sir, what can you make out of this word cost of capital? Sir, capital here in FM terminology, capital means equity and preference share capital or finance? Finance. Finance can be raised either by issuing equity shares or preference shares or debt. So capital in FM terminology means simply finance. Okay. Sir, if you want to take any money like a bank loan or debentures for that matter, will you get it at free of cost or there will be some cost associated with it? Like if you take debentures, if company issues debentures, they have to give interest. Interest may be 7%, 10%, whatever. So that is what? That 7%, 10% interest is what to the company? Cost to the company. That is what we are trying to compute in this particular topic. For each source of finance, we are trying to compute cost of capital. So in this topic, basically we'll be calculating cost of debt, cost of preference shares, cost of equity shares, and one more which we will see. Okay, people? So what is there to calculate, sir? If you have issued 10% debentures, means the cost is what? Company has to pay interest to the debenture holders at 10%. So don't you think the cost of this debenture is 10% itself? Yes, no, looks like that. Then what is the necessary to calculate? Whole chapter is going there, no? Because if it is 10% debentures, the company has to pay interest to the tune of 10%. That means whatever the company is paying looks like the cost to the company. That itself is the cost or cost of that instrument. Why are we again calculating it and why am I emphasizing that it is important and all that? One is, sir, here no, cost does not refers to the actual cost incurred by the company. Cost here refers to the expectations of the providers of finance. Cost here does not refers to the cost paid by the company. It refers to the expectations. Or if I have to go one step back, check this. Or here, this example only I'll take. Here, what was the 10% debenture? What is the cost to the company by looking at this? What are you getting, sir? 10%. Actually, it is not. How? Let's prove it. Let's say, sir, company has PBIT. What is PBIT ka full form? Maybe once we will write for profit before profit before interest and tax only, we call it as EBIT, or you can call it as PBIT. Okay. From this, if you deduct interest, because interest is not yet deducted, no, this is the profit before deducting interest. So from this profit, if you deduct interest, what are you going to get is the profit before tax, or we can simply call it as PBT. From this, if you deduct tax, let's say tax, we'll assume it as 30%. Okay, then what are you going to get? You will get profit remaining after tax, or we can call it as EAT or PAT, as in profit after tax. This is a format. And if you would have done it, even if you have not done it, looks like a simple format. Any confusion, anybody? So let's assume some numbers. I'll tell you why am I doing this exercise in a bit. Let's say profit is 1 lakh rupees. PBIT, profit before interest and tax, I've assumed it to be 1 lakh. So I've taken two scenarios wherein in case 1, the company has interest. In case number 2, company is not paying any interest, and I'm working out these numbers. Let's see how the calculation looks like. Let's assume that interest is 10,000. Assumption, all these are assumed numbers. PBIT is 1 lakh. From this, if you deduct interest, how much are you going to get? 90,000. This is your profit before tax. Tax is at the rate of 30%. Calculate 9 3s are 27. So this is 27,000. Okay, now sir. So profit remaining after paying taxes, 90 minus 27 is 63,000. This is the number you are getting. Under which scenario? When the company has issued some debentures and the company is paying some interest. Let's modify the example. If company has no interest, meaning if the company does not have any debentures, if debenture itself is not there, means will interest on debentures come or it will not arise? Not arise. So that is the second case I'm taking. Two independent scenarios. First case, company has issued debentures. Second case, company has not given debentures. First case we have worked out. You told it's fine. Let's take the same similar things. Profit before interest and taxes, 1 lakh. Here interest is there or 0? Because this which case? No interest wala scenario. That means interest is 0. So how much is PBT? 1 lakh. How much is the tax now? 1 lakh ka 30%, which will be 30,000. Yes, sir. So that means how much is your profit after tax? 70,000. Okay, people. Now I want you to focus on this number right now. This is which scenario, sir? 27,000 is which scenario? When the company has some interest. In second is the case where the company does not have any interest. Compare what happened here. When the company had debentures and when they accounted this interest, tax was only 27. When the company did not have debentures, when there was no interest, the tax amount paid was less or more? That means when the company has no debentures, tax amount will. That means there's a common sense. Debenture interest is an expense. Debenture interest is an expense. Sir, if one expense is there or if one expense increases, means profit will decrease. If profit reduces, means tax also will decrease. That means due to this debenture interest, no sir, you will get some tax benefits. Though you are paying 10% interest to the debenture holders, correspondingly you are also getting some tax benefit. Check here, if the interest was not there, tax you had to pay 30,000. Because of debenture interest, you are paying only 27,000 tax. How much tax did you save? If company has a debentures, how much tax they will save? 3,000. That means due to this debentures, company is saving in some tax, means that only we say as tax benefit. Now, honestly, touch your heart and tell, is the interest on debentures really 10%? Or is the cost of debt really 10% or lesser? Yes. Though you might be paying 10% interest, correspondingly, you are also getting some tax benefit. So, cost is not 10%, cost is actually lesser. Hence, we need to calculate the cost of capital. Background. All this you don't have to know it, just for your reference. Understood? So hence whatever number is given, no, straight away you can't take it. We need to calculate it. That is one scenario. Nana Saro? Online, can I move on? Which one? In this case, it will be 7%. So, Rahul, 30% tax benefit. In 10 ka 30% you calculate. How much is it? 3%. So, 10% though you pay, 3% you will save in the form of tax. So, net cost is only 7%. That's what our Macha told. Okay. No worry. The whole chapter is about calculation. This is what we're going to calculate in the next whatever problems that we have. Fine. Okay. Great. Another reason is, let's say, sir, I've issued the debentures at an issue price of 100. Face value of the debenture was 100 and the company issued these debentures at 100. Possible? Can you give the debenture? Is it necessary you have to issue the debentures at discount only? No. You can issue the debentures at discount or at face value or at par value or for that matter at premium. Any scenario is okay. I've assumed that debentures have been issued at par. If debentures means, can you keep this money forever or you need to pay back? When you pay back only, we call it as redemption. If you're cancelling the debentures, that we calling it as debentures or redemption. Do you think redemption has to be at 100 only or you can pay any money? Redemption can happen at par, premium or discount. Let's say I am redeeming by paying not 100 rupees. I am redeeming by paying 125. All right. How much interest I am paying to the debenture holders? 10%. Okay. Now I've issued the debentures at 100. Okay. And I'm redeeming it at 120. I've taken one debentures for simplicity calculation. You're issuing one debenture at 100 and you're redeeming at 125. Are you giving something extra to the debenture holders on one debenture? Yes. How much extra? 25. Now, honestly, tell me, is the cost really 10% or more? You're not only paying interest, you're also redeeming these debentures at a premium. That means company is incurring some extra cost. So hence cost of the debt is not a 10%, it is something else. Hence we need to calculate. Okay, now that is a necessity. Same example we gave in AS22. Good, you remember. I don't remember. Maybe. Maybe AS20, I think. You're talking about diluted EPS, not AS22. Anyway, nonetheless, it's fine. Okay, yeah. We're not worried about profit part. Okay, we're not worried about profit over here. Can I move on? Okay. This is about why we need to calculate the cost of capital. We'll understand certain significance of cost of capital, a little theory. I don't expect this to come through, but still quickly we'll cover it. In fact, this may come through. So this cost of capital, no, sir, is also known as cutoff rate, hurdle rate, or minimum rate of return. Remember it, again, they may give it all this as an MCQ at best. Okay. In normal old syllabus, all this were not much relevant, but all this now becomes much more relevant. No, just no need to mug it up. Just remember that this is what it is also known as. Okay, the next aspect. Why do we need to calculate the cost of capital? One, it will help us in investment decision. Now let's do a thing, sir. Or we are under one company is there. They want to do one project. Sir, that project is giving a return of 20%. If you do a particular project, it gives you a return of 20% per annum every year. But to do that project, we need money. Okay. All right. So that money we don't have. What do? Raise the finance either by issuing equity shares or preference shares or debt, whatever. Yes, no. Let's say we decided that we will raise this money through debt. Okay. Let's say, or I'll make this as a smaller number first. Let's say it's giving a return of only 8%. And we want to do this project by issuing debentures. Cost of debt is 12%. Okay. Now you tell me, will you accept this project or reject this project? Accept or reject? Reject. Why? Sir, that project is giving you a return of only 8%. But to do that project, you are raising a finance and that finance is costing you how much? 12%. That means this is a profitable project or looks like not so? Not so profitable. Yes or no? It's a loss making one in a way. Yes or no? That means in this case, you will reject the project. Suppose the return was 20%. Cost of debt is only 12%. That means now you will reject the project or accept the project. Accept the project. That means you are deciding this exception or rejection keeping one parameter in mind, which is what? Cost of capital. That is what I've written over here. You can take investment decisions with the help of cost of capital. That's the first aspect. Okay, Nasaru? Any doubts, Saru? Next one. is a financing decision. Okay, sir, we are again raising the money through debt itself. We approached State Bank of India. We wanted a loan. We wanted to issue debentures. We thought issuing the debentures is a whole lot of process. You have to appoint company secretary, draft documents, and host it. People have to subscribe for it. So you thought too much of drama. Let's not issue debentures. We will take a normal bank loan. That is also debt, no? Bank loan is also debt. Debenture is also a debt. Okay. So we approached State Bank of India. They told we will give you a loan. We told we want 10 crore loan. They told interest for you is 12%. We told fine. We also went to ICICI Bank and told what is your offer? They told same loan I will give it to you at 11.5%. Same loan I will give it to you at 11.5%. Now you tell me from where you will take the loan? SBI or you will go for ICICI? ICICI. Why? Lower interest rate. That means what is this 12 and 11.5% and all? It's the cost. So cost of your instrument is helping you to decide what function here. Financing function. From where to raise the money, you can select based on the cost of capital. Okay, fair enough, people. So cost of capital also helps you to select which source of finance also. The next one is designing the optimum credit policy. Now what is this? Sir, in year one, no sir, let's say cost of debt was 10%. In the first year, I have some debentures or I have some bank loan and the cost of that instrument is how much? 10%. Sir, I used to give 90 days credit to my customer or my debtor. You know, normally business undertake what kind of a sale? Cash sale, credit sale, what sale? Mostly the businesses works on a credit sale mode. And how many days credit are we giving to our debtor, sir? 90 days. This is in which year? Year one. In second year, no sir, Vastu problem, economy problem, whatever, cost of debt became 18%. That means if I have to raise the money means I have to pay now only 10% or 18%? 18%. Now, do you think I will give same 90 days credit to my debtor? No. Sir, earlier cost of debt was cheaper. If debtor did not, see, sir, we receive the money, one way of receiving the money is from debtor. So, if the cost of debt is cheaper means, even if the debtor delays the payment, it will not affect me so much because I can take the loan at a lower interest rate and I can survive. Now, in year two, this cost of debt is low or very high? Very high. If this debtor delays the payment, now can I tell my employees, can I tell the best electricity people, water people that I don't have money, I will pay next month? Will they keep quiet? They will say that is your problem. That means if my debtor delays the payment and if I don't have money, what will we do? We have to take a loan. The loan is now cheaper or very costly? Costly. That means now you tell me, will I give 90 days credit to my debtor or I will ask him to pay soon? Maybe I'll tell him that pay within 60 days because the cost of debt or cost of capital has increased. That means this 90 or 60 is what, sir? Credit days. Your credit days is influenced by the cost of capital. That is what they're trying to say over here. Cost of capital influences or it helps you in setting the optimum credit policy. Whether to give 30 days credit, 60 days, 90 days, how many days to give can be determined with the help of cost of capital. Maybe it may not be that important in examination, but quick run through. Okay, sir. Online there. Keep responding in between, so that some of you are telling about internet issues and all, so that we hope that that is not repeating. Okay, awesome. No need to write down anything. Whatever is necessary, I'll only tell that you write down. Rest, you just listen. That should be fine. Okay. Now we will go to this one. Sir, debentures ka features. Can you tell me some of the features of debentures, sir? One, it will have a face value. Yes, no. Like share certificate, if your company has issued debentures means there will also be a debenture certificate. The debenture certificate will have some value. That value we are calling it as face value. Can you tell me the importance of face value? Interest calculations or interest is paid on face value. Okay, this is a quick run through. I mean, again, not much relevant for exam according to me. Next is, if you have a debt means, obviously on that debt, you need to pay some interest. Maybe monthly, maybe quarterly, maybe 6 months once, or maybe annually, but you have to pay some interest. That is the second feature of a bond or a debentures, or for that matter, a debt. Okay. Maturity period. So like equity shares, will debentures or a loan last forever, or at some point of time you need to repay? Repay. That means all this debt will have a maturity period, meaning it could be within 5 years you may have to repay, or within 10 years based on the agreement. At some point of time you need to repay. That point of time we are referring it to here as maturity period. Next is the redemption value. Redemption value means, let's say you have issued debentures for 5 years. You have issued 10% debentures and the period is 5 years. That means at the end of 5th year, what do you need to do? Pay the debenture holders their money back. Okay. Suppose you have issued debentures initially for 10 lakh rupees. Okay. In the year 1, you have issued debentures worth 10 lakh rupees. At the end of year 5, should you have to still pay 10 lakh, or you may pay anything more also? You may pay more also, you may pay 10 lakh also, or you may pay little less also. Okay, that means that value you pay at the end of 5th year, let's say you paid 10.5 lakh. That 10.5 lakh only we're calling it as redemption. At the end of the instrument, whatever value you are paying to close that instrument, that we refer to as redemption value. And we already discussed here, if it is a debt, means on that debt you need to pay interest. Due to that interest, you will get some tax benefit. So these are some features. Okay, people. Okay, now the numbers thing. If I have to take now, till here it was okay. Now onwards, whatever we study has a lot of exam relevance. Pay attention and try to remember as much as things in the class itself. So next few concepts you may encounter about 6 to 8 formulas. If you know that, you don't need me for the next 20 or 25 questions. That's all is based on the next 25 questions. We'll not do everything today. We'll try to see how much is possible today and take it up. Okay. So let's start with calculation. First, we are trying to calculate. All of you are there, no? Not yawning, no? 8 to 10. Not Buddha zone, no? Still 1 hour is there, no? Okay. Not even responding. They're saying, break. Already gave 5 minutes break. Over. Next. Comes in. I put an asterisk mark. You didn't listen now. 1 hour will finish and leave. That's okay. Now, all calculations, no, what is big deal? See, theory I can understand. You are not writing. This is all calculations. Around the time will pass. Don't worry. Okay. Listen. We are calculating the cost of debt. Sir, debt for this purpose. Debt for this purpose are classified as redeemable debt, irredeemable debt. It's there over here, just underline, that's good enough. Redeemable and irredeemable. So first we will calculate the cost of irredeemable debt. We'll work out some problems. Then we will move towards calculating the cost of redeemable debt. So the first thing you need to remember is, sir, cost of debt is denoted by the symbol KD. The moment they say KD and they're looking at my face, I am not KD, pa. I gave you the break, pa. Someone is wondering what is KD. KD in Kannada means thief. Probably in Malayalam also, what? Huh? Tamil also same. Tamil also same. Tirada, no? Tamil Tirada paya. Tirada pasanga and solong, yeah. Okay, Tirada. Okay, I am not Tirada. Okay. Okay, Telugu also same, what? Antara. Chari, okay. Alright. Tamil also same. Awesome. So I am not KD, that is the point. So cost of debt is denoted by the symbol KD. If you are calculating the cost of irredeemable debt, then the formula is, you need to remember this. I suggest whenever a formula comes, write it down in your books. And whenever you're solving the question, as many times as problem, just keep writing those formulas so that it gets registered. Okay, you need to remember this. Formulas will not be provided in examination. That's the reason in the first video only I told FM is more towards formula and formats. So the chances of losing marks are less because too many adjustments may not be there. Some attempts may here and there could happen, but mostly it will be a straightforward one. Okay, listen up. Okay. KD is given by interest into 1 minus tax rate divided by net proceeds. This you need to remember. Cost of debt is given by the formula interest into, I here stands for interest rate, T stands for tax rate, NP stands for net proceeds. I is equal to interest rate, T for tax rate, NP stands for net proceeds. If it is irredeemable means what, sir? First of all, irredeemable means, do we have any fixed maturity period or no maturity period? Meaning it will go on for ever. Very, very rare. But again, these are all only for the sake of books and for the sake of marks. Practically, nobody will be ready to subscribe irredeemable debt. Do you think any bank will give forever loan? Forever? No. Will any debenture holders buy forever debentures? No. Maybe 15 years, 20 years. Correct? It could be long, but it will definitely come to an end. This is only for the sake of marks. I don't know, sir. So some things in the syllabus, no, are only for the sake of marks. Because see, CA is not just about application. Our institute, no. Normally, like probably this is one of the advantages, or for that matter, you can call it as disadvantages also. Normally, all the foreign exams, this is what I've observed. I did a small stint on CMA US. I've just gone through one paper and I used to teach it long back. And I teach ACCA also. There, the approach is most of the data will be given to you. You don't have to remember much. All you have to do is apply. They will give you the data, you need to apply. So that tests your application skills. But in CA, the approach is little different. They will say, you only remember, you only apply. We will check and give you marks and give you degree. That is CA approach. Okay, it's a more holistic approach. Okay, unfortunately, as long as it is there, we need to study. So not everything that we study will have practical relevance. Many things are there, but slowly the syllabus have changed. Like we had, previously we had accounting and advanced accounting. There were many topics in both the syllabus which were practically not relevant. It was only relevant for the sake of marks. Now they were all taken away that and probably pushed it to little foundation, no, Papa, those guys. Okay, now we have all standards in syllabus like that. So it has become more relevant. Like that, as time passes, the syllabus also will evolve. So here, for the time being, the way it is, we have to study. If you don't like it, they say, no, if you don't like the rule, get to the top and change it. Till then, follow the rule. Can't help it. Yeah. Okay. Have you written this down now? Cost of you have to remember it. Interest into 1 minus tax rate divided by net proceeds. Okay. Can we calculate in one of the questions, sir? Yes. Okay. I'll tell you, there'll be some adjustments in this also. We'll do that as and when we see the problem itself. Okay. First thing, observe. I'll have to solve. You need to copy one problem. Stay with me. I'll give you time. Understand it. If you understand, the next one will be pretty much similar, I think. Check this. 5 years ago, underline that if you can. 5 years ago, Sona Limited, that's Sona, which we are doing in the class right now. Sona Limited issued 12% irredeemable debentures. So we got to know that it is a irredeemable debentures at 103. So what is this 103, sir? Is it the face value or issue price? Did you issue the debentures now or 5 years ago? 5 years. Every line, every wording is important. No need to write down anything. First observe. Okay, I'll give you time for this. Understand one problem because every word has a lot of significance here. So 5 years ago, you have issued some debenture and you issued at what price? 103. So IP as an issue price is 103. At 3 rupees premium to the par value 100. So the face value of the debenture is 100. It was issued at 103. Okay. Not now, 5 years ago. The current market price of the debenture is 94. Right? If the company pays a corporate tax at the rate of 35%, calculate the cost of debenture capital. Meaning they are asking you the cost of debt because debenture is a debt. So we need to calculate KD. Okay. So what sort of debt is this? Redeemable or irredeemable? Okay, the first thing we will write is in every problem, we will write the formula for our reference. How do you get that, sir? AD is equal to interest into 1 minus tax divided by net proceeds. 1 minute. We'll fill out those data. First, I'll write observe. No, I'll give you time. Observe first. I here stands for what, sir? Interest. Okay, interest rate, it should be in it. I have wrote interest rate. No, make it as interest amount, not rate. Interest amount actually. This is. I is interest amount. Don't copy. First observe. I'll give you time to copy for this one. Observe. Sir, interest, no, will you calculate it on the issue price or face value? Face value. What is the face value of debentures? And what sort of debentures are these? No, matlab nature nahi. Interest rate is what? 12%. Sir, face value is 100 and the interest rate is 12%. So what is the interest? I don't want the total interest. We will calculate interest on one debenture. That is, you can calculate at total level also. You can calculate on one unit also. Answer will be same. But they have given all the total value or one debenture ka value. Market price and all they have given for one debenture. No? Hence, we will take one ka value and accordingly calculate. So what is the interest on one debenture? 12. Any problem till there? No. So you got the I here. So T here stands for what, sir? T is equal to tax rate. Have they given tax rate in the question? Yes. How much is that? 35%. So 35%, if you want to express in full number, it will be 0.8. So you got your T there. Last is NP. NP is what? Net proceeds. This you carefully observe. So net proceeds, no, could be either of the two. It could either be this net proceeds, no, could either be your issue price or it could be market price. Your issue price, your net proceeds could either be issue price IP or market price. So which one should we take if we give? They give both, sir. If it is new debentures, if it is a new debt, that means you have issued it now. If it is new debentures, you will always select issue price because we want the latest data, because we are trying to find out the cost now. No, if you're finding the cost now means will we use 5 years old data or now ka data? Now ka data. Okay. So if you have issued the debentures now means we will use IP as net proceeds and do your calculation. Easy. However, if it is existing debt or if it is an old debt, then is issue price irrelevant or issue price? In this case, the debentures was issued now or 5 years before? 5 years before. That means that 5 years value is irrelevant because we are calculating the cost now. Now you fill this blank for me. If it is existing debt means will you take issue price or will you take market price? Which market price? Current market price. Understood? Yes, that's how to determine whether you should take issue price or for that matter, market price. Hence each wording is important. Again, repeat it once for me. This is important. Your NP could be either of the two. What are those two? Either it could be a issue price or market price. When will you take issue price? Basically, we need latest data. Okay. If it is new debt, then we will take issue price. If it is existing debt, then issue price is very old data. We will take current market price. Online also okay, no? Okay, if it is good, you tell me here. Here you will take, they've given IP also, they've given market price also. Which one you will take it as net proceeds? In this problem, you will take IP or market price. You will take market price. Why? Because these debentures were given when? 5 years ago. So this IP is a data, this 103 is a data relating to 5 years before. Hence we will take what's a current market price. So that means your NP, what will you write? The current market price, which is what, sir? The current market price is 94. Okay, now? And plug in the numbers, you will get it. So how do you get the cost of debt? Interest, which is 12 into 1 minus tax rate. How much is the tax rate we have got? 0.35 divided by net proceeds, which is 94. Do this calculation. Numerator, somebody tell me. This one is how much? This calculation, 7.8 divided by 94. How much is the cost of debt? 0.08. 0.0829 or 0.829? 0.0829. Okay. Fine now. Sir, when we say cost of debt, we express it in percentage. But this is in full number, no? Multiply this by 100. You will get 8.29%. This is the full number, but we'll express the cost of debt or cost of the instrument in percentage. Hence, the cost of debt is 8.29%. Tax rate is given in the problem. I did not calculate. Tax rate is given in the problem as 35%. 35% if you express in full number, it will be 35 divided by 100, which will be 0.35. You can take 2 decimals. Some problem I say it takes 2 decimals. Sometimes they go up to 4. According to me, okay. Here you can take 2 decimals if you consider it should be okay. Okay, someone who said there, Harshita, is it okay, pa? Aditya and Harshita, are we good? Did we get? Has your doubts been solved? Now you're free to copy.
So fresh issue wasn't issued during the year.
We're calculating that. So we generally in those problems, current market price will not be given, and the date also they will not give.
In practical cases,
No.
the market price could go down during the year.
On whatever date you are finding it out, that day ka market price you take. We'll see. All that will come in next set of things, one by one. This one we understood, no? Everybody okay? All right. KD ka full form, cost of debt. Okay. Copy. It can be issued at discount also, not a problem. Since it was issued 5 years ago, we don't need 5 years ka data. For existing debt, we always consider current market price. So 5 years ago, you could have issued at premium or at par or at discount. That is irrelevant for this problem. Okay? Nishkala. Fine, Amma? Yes, 103 data is irrelevant in this problem, Raghav. Correct. Yes. Done with copying also? Okay. The next. This is for what, sir? What sort of a debt? Irredeemable debt. Is that the only debt you'll have or more better one? What is the better one? Redeemable debt. If it is a redeemable debt, then the cost of debt is given by the formula. Same. First is same. Interest into 1 minus tax rate. Why do we multiply 1 minus T is? On interest, we get the tax benefit. Like here, let's say you pay an interest of 10,000 rupees. You pay interest at the rate of 10,000 rupees. Let's say tax rate is 30%. Okay. All right. Now you tell me, sir, is the cost for the company really 10,000? In FM terminology, you think, is the cost of the company really 10,000? On one hand, you paid 10,000 as interest, but on interest, you will get some tax benefit. So how much is that tax benefit? TB. 10,000 is the interest. On this, you will get a tax benefit of 30%. That means the tax benefit you will get is 3,000. On one hand, you paid 10,000. On another hand, you are getting a tax benefit of 3,000. That means what is the net cost for the company? 7,000. Yes or no?
Yes.
Correct, no people? Yes, now you calculate this interest into 1 minus tax rate. You do full amount you take and calculate. Interest is 10,000. Tax rate is 30%. 30% is 0.3. Calculate this. How much are you getting? Are you not getting the same number? That's what formula is trying to do. Okay. So it is trying to calculate after tax interest. After considering tax benefit, what is the net interest is what it is trying to calculate here. That's why we multiply 1 minus tax. Easy. Net proceeds here. Somebody is saying, why do we divide net proceeds? Simple, sir. I have issued debentures worth 10 lakh or 1 lakh. Interest rate is 10%. Okay. Or debenture ka value is 1 lakh. Interest amount is 10,000. I forgot your name, sir. Chetan. Chetan, you have invested in one company ka debentures by paying 1 lakh rupees. And on that debenture, you are getting an interest of 10,000. Can you tell me how much is the return you are getting? 10%. How did you calculate? 10,000 divided by 1 lakh into 10,000 is the interest. 1 lakh is the net proceeds. 1 lakh is the net proceeds. Here we are taking full value, but in the other question we took only 1 unit. That's we multiply by 100 because we want it in percentage. Okay, but due to interest, company will also get some tax benefit. Hence, we don't consider only interest in the numerator. We do 1 minus tax rate. Hence, the formula is what? Interest into 1 minus tax rate divided by net proceeds. If you multiply it by 100, you will get it in percentage. Okay, that's the thing. This is for irredeemable debt. Okay, G. Okay, G. Okay, G. I'll come to one by one. All that may not be relevant now. I know that there are some concepts in this also. Those are common concepts. We can do it anytime. First, let's start with basics. Let's not take everything and bombard ourselves with too much things. We divide by net proceeds to get the return part. Same, that's all. If you have invested 1 lakh and if you are getting 10,000 as the interest, means the return is 10% for you. Yes or no? 1 lakh ka 10% is 10,000. Calculate in your calculator. 1 lakh ka 10% is 10,000. It's like this. How do you calculate interest amount? How do you calculate interest amount? You will take the debenture value multiplied by the interest rate. Sir, if I have to find out interest rate, revise the formula for me. If I'll give you debenture value, I'll give you the interest amount. Can you find out the interest rate for me? How do you get interest rate? Interest amount divided by debenture ka value. Into 100 if I do, you will get the value. This interest you should take after tax interest. This debenture value only we are calling it as net proceeds. We are not taking whole net proceeds. We are taking net proceeds relating to only one debenture. Whether you take it for one debenture or full value, answer will be same. It will not change. That's the thing. Okay, people. This is with respect to two irredeemable debentures. Next is with respect to the redeemable. Redeemable debentures means the formula is interest into 1 minus tax rate. You have to remember this. Plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. So formula. You have to remember. Nobody will give you this. Okay. So this is the formula given over here. I've written it once again for your reference. If it is a redeemable debt, the formula is, write it down in a notebook. It's fine. It's there, I know. But once if you write, it will be better. These things, no, you need to practice. That's the only way you will be able to remember it. Interest into 1 minus tax rate. RV is what, sir? RV means redemption value. NP you already know, which is net proceeds. N is the remaining life of debentures, not the total life. The word is there is remaining life of debentures. Write that down once. We'll apply it in the next two questions. The same thing. Don't worry, we have 5 to 6 problems. Initially, it may look like fancy. Later on, you feel these sort of problems are your saviors in examination. Because, you know, full formula means full marks. You don't remember formula means? Full toss. Full or nothing wala problems these are. That way, examination may golden questions. Not much time also it will take. All about memory these are. Many people have done their own analysis and they come up with their formulas like this. It's not necessary all these formulas are 100% proof. All these are some person ka data. Whose data they have not mentioned, even I don't. No, you can set it off with security premium. That is balance sheet, I guess. P&L. Here, no, where you charge and all is irrelevant. Because in FM, no, we are not working with profits. Okay, we are working with what is the expectations. So, security premium, you adjust the premium with security premium or P&L, it really doesn't matter. Cost and then what is the return expected. So, expectation matters there. That is accounting purpose. How you do with this is accounting analysis. It doesn't have an impact on FM. Okay. All right. Yes, people. Okay. Again, once again, I you know already. What is I? Interest. T you already know, which is tax rate. RV stands for redemption value. NP for net proceeds. N is for total life or total remaining life. Total remaining life of that particular debt. Okay. So let's take up question number 2 and let's see how much of it we remember. 2 and 3 is I think related to that. Don't worry about remembrance. I'll make sure that you remember it. We have enough problems to do so. It's all a matter of solving 1 or 2 questions and it will sink in. Carefully listen. I'll read the data. You will tell me what of the components each are. Company issued 10,000 10% debentures. What is this 10%? Interest rate. Okay. Of 100 each. What is this 100, sir? Face value. A company has issued these debentures. Did they say this was issued 5 years back, 10 years back? They said the company has issued. That means the issue has happened in the current. The company has issued it now. What is its significance? If it is new debt, will you take net proceeds as current market price or IP? The issue price itself will be taken as net proceeds. Correct? Whatever I'm saying is sinking in for everybody? Okay. So we have issued the debentures of face value 100 at a premium of 10%. That means, can you tell me what is the issue price? 100 is the face value, but you have issued at a premium of 10%. 100 ka 10% you calculate, it will be 10. That means IP is 110. Either you do 100 ka 10 and separately add it to 100 or simply do 100 plus premium of 10%. Automatically you will get issue price of 110. 10. Any problem, anybody? They've issued this debentures on 1st April 2017 to be matured on 1st April 2022. Sir, if it is matured means then will it go on forever or at some point of time it will come to an end? So by reading this maturity word, what sort of a debt is this? Irredeemable or a redeemable one? This is a redeemable debt. Okay, first observation. The debentures will be redeemed on maturity. What is that maturity date? 1st April 2022. Okay, 1 minute, sir. You've issued this debenture on 1st April 2017. You are cancelling or paying back this on 1st April 2022. So count from 1st April 2017 to 1st April 2022. 1st April 2017 to 31st March 2018, 1 year. 31st March 2019, second year. 31st March 2020, third year. 31st March 2021, fourth year. 31st March 2022, fifth year. On 1st April 2022, you are redeeming. 1 day later. That means what is the term of these debentures? 5 years. Okay. Alright. Sir, they told debentures is redeemed. In fact, they told calculate the cost of debentures assuming a tax rate of 35%. Sir, have they given RV redemption value? So they just told it is redeemed on maturity. If they don't tell anything about redemption, we always take that the redemption has happened at par. What is the par value? That means RV also you know it as 100. Plug in these numbers in the formula. Okay, no? Alright, 1 minute. So again, they've not given any drama there. They've not given current market price because it is not required. Why? Because it is a old debentures or a new debentures. For new debentures, do we need market price or we need the issue price? Okay. So calculate, sir. This, if you want, we can do it together. Cost of debt. First of all, what sort of a debt is this? Redeemable or irredeemable? Redeemable, correct? No. In 5 years, we are redeeming this, correct? So redeemable debt, we will give the heading as. If it is a redeemable debt, repeat it once by yourself in your mind and try to remember those formulas. Cost of debt is given by the formula interest into 1 minus tax rate plus RV as in redemption value minus net proceeds divided by N. N as in remaining life of the debenture. Whole thing divided by RV plus NP divided by 2. If you want, you can multiply it by 100 also, or you can do that at the end. So can we plug in those numbers now? Or maybe once again for our reference, we will write I is equal to what, sir? I is equal to interest amount. Interest you will calculate it on the issue price or on the face value. What is the face value? 100. What is the interest rate? 10%. So 100 ka 10% is how much, sir? 10. That is your interest. T for tax rate. The tax rate is given to be 35%. 35% if you want to express it in full number, it will be 0.35.
But they mentioned that there are 10,000 debentures.
Calculated one level because they've given all the data for one debenture. No? You don't have all other data for whether you calculate for 10,000 debenture or one debenture. Answer will be same. So you do it at one. It's okay. If you have all the data, you can do it for full also. No big deal. That's okay. All right. Now coming back, what is the redemption value? They just told it is redeemed. They did not give the redemption value. That means it will be redeemed at par value only or face value itself, which is 100. NP as in net proceeds. What is the net proceeds? Will we take current market price or issue price? Issue price. What is the issue price, sir? 100. Face value of the debenture was 100. It was issued at a premium, they told. No? Yes. It was issued at a premium of 10%. So the issue price here is 110. Since it is the new debentures, we are taking IP. And N is what? Total life or remaining life? Sorry, we issued the debentures on 1st April 2017 and its maturity is on 1st April 2022. So if you count the term, the N or the remaining life is 5 years. So N here is 5 years. Can we plug in all these values and see the end result? So cost of debt again is given by interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. So what is I? I is just now we calculated, which is 10 into 1 minus tax rate. Tax rate is 0.35 plus RV, which is 100, minus NP, which is 110, divided by N. N is 5. Whole thing divided by RV, which is 100, plus NP, which is 110, divided by 2. Calculate the numbers one by one, sir. First one is 6.5. Okay. Next, I think this is minus. One by one we calculate. This is minus 2 divided by 105. Okay. KD is what, sir? 4.5 divided by 105. How much is cost of debt? Now give me in decimals. You will get 0.0428 you're getting. This you express it in percentage. It will be 4.28 percentage. That's it. This is reducing. Somebody is saying, why are we doing this, sir? Sir, okay, check this. Someone who's having the doubt there. It's, sir, all these are approximates. So somebody's data that they are trying to express in formula. Check here. A company, they've issued the debentures at what price? 110. That means how much money did they collect from the debenture holder? 110. You have to repay this, no? We took 110 from the debenture holders now, and we are paying how much, sir? We took 110 and we are repaying only 100. That means it is a cost for the company or what? Company took 110. It's like taking 110 loan and repaying only 100. That means this is the cost or reduction of cost. That's the reason we do this. Okay. So it's a profit. That's the reason this number is coming as a negative. Cost of the debentures, in fact, is reduced. Okay, people. And moreover, one second. This, this you took 110 now. You're repaying 100 now or after 5 years. That means there is a time value of money concept. Hence, they are dividing it by N. They don't use that I and all here. This is an approximation method. Hence, they said divide by N. That will approximate the time value of money ka effect. Hence that. Okay. And here in the denominator, again, net proceeds is now. Redemption value is now or after 5 years. Hence, they have taken average price in the denominator to give time value of money ka effect. Hence, we say these sort of formulas, we call it as approximation method. They are not exactly cost of debt, they are approximation method. Okay. So that is the formula ka funda here. Okay. Got it off. You just have to remember it. Since you asked, I just mentioned that. Good, everybody. Zoom out. What update? Okay, copy. Others can try question number 3. It is same or similar. Read it, work it out. Somebody are updating it. I'll be with you in a minute. Finished or online is still copying this particular question. Now the next one. You need to get yourself added to that this particular group. I don't know whether they've created for Chennai branch and other this thing and all. Raise a ticket or I'll ask someone to share it across with you. Okay. Now for new, no, it's not on the redeemable, irredeemable. If it's a new debt, you will take issue price. If it's existing debt, you will take market price. That's all. Sometimes all the data will be given, sometimes data will be missing. So it's fine, but this is how we select. Okay. Soumya, can we move on to the next question? Is it sorted? Yes. Okay. Question number 3. Okay, let's go through this now. It's a similar one. A company issued 10,000 10% debentures. 10% is the interest rate. What of 100 each? What is this 100, sir? Face value. And they've issued at what? At par. Okay. So IP is also 100. But one second, pay attention. It's okay. If you are doing it, stop there. Just look at the screen for now. You can update it in a bit. They've issued on what date? 1st April 2012. To be matured on 1st April 2022. So count, sir, from 1st April 2012 to 1st April 2022. It is 10 years, correct? From 1st April 2012 to 1st April 2022. It's about 10 years. Okay. The company wants to know the cost of existing debt. On which date? 1st April 2017. 1 minute. We want to know the cost of debt on 1st April 2012 or 1st April 2017. These debentures are newly issued or it's already issued. So it is a new one or existing one. For existing one, you should use what as net proceeds? IP or market price? The issue price or current market price? Current market. Check, have they given? The market price of the debenture is 80. So this 80 becomes your net proceeds because it is existing debt. Is that sorted for everyone? Okay. Compute the cost of existing debentures assuming 35% tax rate. Okay, let's solve it here again. Now I think I'll directly plug in the numbers in the formula. Would you be okay with? It's not necessary like this you need to present, sir. First calculate all this and then plug it in the formula. Not necessary. Write the formulas and directly start the solution directly from here. Okay, first two problems to make you comfortable. I made you write all this. That's all. Now we'll directly plug in. Okay, but first tell the we need to essence is to remember the formula. What sort of a debt is this?
Redeemable.
It's a redeemable debt. Okay. So how do you get the cost of debt here, sir? Tell me the formula once again. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Are you able to remember this? Okay. So calculate the interest. Face value is 100. These are 10% debentures. So can I directly write? 100 ka 10% is 10. Into 1 minus tax rate. What is tax rate in third question? 35%. 35% if you have to express in full number, it will be 0.35. Plus RV. What is RV? Have they told that these are redeemable at 5% discount, 10% premium, anything or nothing?
Nothing.
If they don't give any redemption information, we'll always take it as it is redeemed at par. Or par of face value is how much? 100. Minus net proceeds. How much is net proceeds? 80. Since it is existing debt, we will take the current market price, which is 80. So 100 minus 80 divided by N. N is what, sir?
5.
N is 10 or 5? N is 10 or 5? Stop here and carefully everybody answer this. Otherwise, you may ask this again. 10 or 5? How 5? N is not the total life. N is the remaining life. Sir, are we calculating the cost of debt from 1st April 2012 or 1st April 2017? Sir, we are calculating cost of debt on 1st April 2017. And these debentures are getting matured on 1st April 2020. So count from 1st April 2017 to 31st March 2022. That's about 5 years. N is not the total life, it is the remaining life. Okay, no? Okay, N is 5. Again, replicate the same number in the denominator. RV, which is 100 plus
80.
net proceeds, which is 80 divided by 2. So tell me, sir, this is 6.5 plus 4 divided by 90. You're gonna get 0.1167. Huh? Or if you multiply, this is the full number. We wanted in percentage, so we multiply it by 100 and show it as 11.67%. N is the remaining life form. Because we have to give the time value of money effect. No? Time value means what? The difference between present value and future value. We are in what now? We are in 1st April 2017 now. Debenture is getting, the present value should be calculated on 1st April 2017. The future value is 1st April 2022. That difference in time value is shown as N here. So hence N is not total life, N is the remaining life. So from whatever date you are calculating cost of debt, from that date till maturity date you need to take to calculate N. Okay. That time of the day where you are saying enough, I say next problem. Target is not met. No way. 2-3 problem shortage. Okay, we'll do 1 or 2 more, 5 minutes and then we'll leave. NP, why we took market price? We wrote here, Nuda. You didn't copy here. And I told no already here. Where is that? First line only we told no. If it is new debt, we will take issue price. If it is existing debt, we will take market price. Here only given no. Okay. Since these debentures in this problem, it was issued many years back. Hence, we have to take current market price as NP. Like this. We need basically latest data. That is the logic. Okay. Since debentures were issued many years ago, issue price is many years before data. Current market price is latest data. So we have to work with latest data. That's all. That's the logic of these. Okay. We did not get break. That is the logic part. That's all. Whenever these are all approximation methods. Okay. These are ways to get the cost of debt to a closer number. Okay. Right. So when you are working out the cost, you need some data, no? Will you use 10 years before data or the one which is most relevant or recent? You will use the most recent data and do it. RV we always take it as, if they don't give, we take it as it is redeemed at par. Par value is 100 here. Like that. If there is a different value, they'll mention. If they don't mention, take it as 100. Others, try question number 6. Or 1 minute. Yeah, question number 6 you try. Or 1 minute, hang on. Try 7, sir. Try 7. Matlab, go through 7. You'll not be able to solve it. Just go through. I'll help you out with that. 7th question. Okay. Alright, let's. I'll ask them to share the notes. Has all the Chennai people not got the notes? I asked them to send. I was not aware. Or only you have not got. Someone is saying got it, no? Maybe you didn't check in the group, I think, Sharon. Just check again. Others are saying they got it. Or get yourself added to both the groups so that you will get all the informations. First, we'll finish the things part. Then we'll do other extra things. A lot of existing content is pending. Okay. You have decided, we'll go on. Okay. 5 minutes over, we'll finish. I know that you have reached that zone. So have I, but we'll finish. 5 minutes. Chintu question. Okay, listen. We'll finish off this. Okay, sir. So far we calculated cost of 5 minutes. Listen, small problem, small concept over. If so far we have calculated cost of redeemable debt as well as irredeemable debt. But debt can also be convertible. You can convert debentures into equity. So if it is convertible debt, how do you calculate the cost of debt is the next concept, and that question is relating to that. Okay. So if it is convertible debt, normally this conversion option will be given to the debenture holders. Listen, no need to copy anything. Directly we'll take up all the information in question itself. First listen, 2 minutes I'll explain and then we'll take up this question. If it is convertible debt, generally the conversion option will be with the debenture holders. The company will give the option to the debenture holders. 2 options. 1, the debenture holders can take cash and the debentures will be redeemed. They can take cash and debenture will be repaid, or debentures can be converted into equity shares. Generally, this option will be given to the debenture holders. Okay. So now, what do we take as redemption value? Because to calculate cost of debt, we need RV. Here, RV is fixed or 2 components are there? 2 components. Debenture holders may take cash option or they may go equity option. What do you think? What do you think it should be taken? You put yourself in debenture holder shoes. You think you are the debenture holders. What you would have chosen? Cash value or share value, whichever is fine. That is what you need to take as RV. That's all is a concept. Understood? So if it is convertible debenture, RV is nothing but what, sir? Is higher of two things. What are those two things? Cash value or share value. We need to calculate the cash value and we need to calculate the share value. Whichever is higher, that becomes the redemption value. Because cost, I've already discussed in the first line itself, cost of capital means the actual cost or expectation. Expectations of whom? Providers of finance. So providers of finance obviously will expect the lower of the two or higher of the two. Higher of the two. So we are doing all this calculation from the providers of finance perspective. Okay, sir. So this is the funda. So it's given. If you want, you can write this down or I'll write this in the problem also. Fine. This is the only extra fitting. Understood? Rest every formula, every component is same. Can we calculate it? Go ahead and apply this question or this concept in one of the next question. Everybody? Okay. Come to question number 7 then, everybody. A company has issued 10,000 15% convertible debentures of 100 each. What is this 100, sir? Face value. Now they've issued 10,000 debentures. Should I have to calculate the cost of debt at a total level or can I calculate it for one also? Whether I calculate it for full debenture or one debenture, final answer will be same. If you are calculating it for full debenture, then calculate the total interest on what debentures? 10,000 debentures. Calculate the redemption value on 10,000 debentures. Like that. If you're calculating on one debenture, then take the value only relating to one debentures. Final answer will still be the same. Okay, so face value is 100 with a maturity period of 5 years. Okay, looks like what is that 5? Looks like N on this read, yes or no? But N actually is not the total life, it is the remaining life. But so far, okay, we'll read it and finally confirm that N part once again. At maturity, debenture holders will have an option to convert a debenture into equity shares in the ratio of 1:10. 10 share for each debenture. So if he's owning one debenture, will he get only one equity shares or 10 equity shares? That's what they've agreed. For one debenture, they will get 10 equity shares. The current market price of equity share is 12 rupees. Okay. And historically, the growth rate of the share is 5% per annum. Calculate the cost of debentures assuming 35% tax rate. Anyway, this is a convertible debentures. So first we will calculate of RV. Then all the other numbers we'll plug it into the formulas. Can we do that? Okay, first write down parallelly along with me since you are already in that zone. Yeah, better, we'll do it together. So first we'll calculate working note number 1, we'll put it as RV. RV as in what, sir? Redemption value. Redemption value will be what? In case of convertible, you can give the heading as convertible debentures or convertible debt. Sir, debt means they can call it as debenture, they can call it as bank loan, they can call it as bonds. Everything is a debt. Sometimes they may use the term debenture, sometimes they may use the term as bond. Okay, anything. You use the same funda, don't get disturbed by that. Okay, it's the same. Okay, in case of convertible debenture, redemption value is higher of what, sir? Higher of cash value. We'll calculate of this. What is the cash value? Have they told that these debentures are redeemed at 120, 130, anything like that? They just told it is redeemed, but they did not give any redemption value. So if they don't give any redemption value, we'll take it as what? It is redeemed at par. And the par value is what, sir? 100. Any problem?
No, sir.
Simultaneously write it off. I'll wait. Carry on, huh? Okay, then we want what, sir? One more component, which is the share value. Okay, now just observe. Share value. Okay. Sir, we are trying to find out what? RV. RV means now. It will come now or later. When is that later? Now or after 5 years? The maturity period of 5 years. Yes, no, sir. So you are trying. You will give the shares now or after 5 years? After 5 years. Because maturity term of this debenture is 5 years. check, have they given share price at the end of 50? On one debenture, you will get 10 shares. Okay. If you know the value of shares, simply take the value of shares and multiply it by 10 because you are getting 10 equity shares. Correct? No? Yes. You need the value of equity shares now or at the end of 5th year? End of 5th year, because we are trying to calculate redemption value. But check in the question, have they given equity share price now or after 5 years?
No.
The current market price of equity share is 12. Okay, but we need the value of equity shares or market price of equity shares after 5 years. That means, can I take this and straight away multiply 10 and do the calculation? Because this is the current market price. And they're saying what over here? Historically, as per our last records, the growth rate of share is around 5% per annum. Meaning every year, no, share price will increase by 5%. That is what they're trying to say historically. Okay, now. That means what is the share value? Can you tell me, sir? The share value now is how much? 12. Huh? Okay, 12. One approach is simple. Value is 12 now, but we need the value after 5. Every year it will increase. The share price will grow or increase by how much they told? 5%. How many years are still remaining? 5. So add 5% in your calculator 5 times. Take 12. Take 12. Simply add plus 5% you do. 5 times you do this. How much are you getting? 15.31. All of you got this calculation? This is one simple way to do it. Okay. Or you can use your maths ka formula. See, this 12 rupees is the present value. We need the value after 5 years, which is the future value. So we know this, no? Future value is given by the formula present value into 1 plus R or I. You can use whatever, whole power N. Do you remember this?
Yes.
This is what we used to do it. Okay. So we need to find out the future value. What is the present value? 12 into 1 plus I. I is what, sir? 5%, but take it in full number. 5% if you have to express in full number, it will be 5 divided by 100, which will be 0.05. N will be what? N will be the maturity term. We need the value of the shares after 5 years. So do this. So 12 into 1.05 whole power 5. 1.05 into 1.05. 5 times you multiply. 1.05 into 1.05. 2 times over. Again go on pressing equal. Into 1.05. 5 times multiply. How much are you getting?
1.2762.
1.2762. Correct?
Yes.
12 into 1.2762 is how much?
15.31.
15.3. According to me, this is easy. Just simply need to add it. If you want, you can use this also. Your call. Whatever you feel you're comfortable with, you can apply. One of the two or both of the two, you got it? Yes sir, no sir, what sir?
Sir, into 10.
I'll calculate that. Share value? Oh, fine. I'll show that separate. You can write it here only. It's correct. 15.32. Okay. Okay. One number may, let's not fight. 3-1, it's okay. We'll stick to that. It's okay. Sir, this 15.31, everyone okay now with this? Sir, 15.31 is the value of 1 equity shares. Is the debenture holder getting only 1 equity shares or 10 equity shares? 10 equity shares. That means what you have to do over here? Share value is equal to. Don't need to show both. Show one of the two. One share ka value is 15.31. But debenture holder, no, on one debenture they are getting 10 shares. That means the value of total equity shares they're going to get on one debenture is how much? 153.10. So cash value is 100, share value is 153.10, which is higher. Share value. Therefore, RV is what, sir? RV is higher of the two, which is 153.10. Any problem? Problem over, or we have all the data now? We have all the data. We need to find out the cost of debt. Can we do it online, or anybody still updating? Or any confusion in the online? If you want full forms, FV stands for future value, PV stands for present value. Okay. So how do you get cost of debt? Again, tell me, sir. Cost of debt is nothing but interest into, first of all, what kind of a debt? Irredeemable or redeemable? Redeemable. So that means the formula will be interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Can we plug in all these numbers now?
Yes.
Sir, face value of the debenture is 100 and what percentage debentures are these? 15%. 100 ka 15%, the interest will be? You want me to plug all the numbers individually or directly in the formula is okay? So interest is 100 ka 15%, which is 15 into 1 minus tax rate. Tax rate here is 35%. 35% if you have to express in full number, it will be 0.35. That is 35 divided by 100 plus RV. RV just now we got it to be 153.10 minus NP. Have they given NP? No, they only told we have issued convertible debentures of 100 each. The company has issued it now. Face value is 100, but they have not given IP. If they don't give any issue price, what do we normally assume? The debentures have been issued at premium, discount or par? The debentures have been issued at par itself. So IP is what here, sir? Net proceeds will be IP of 100. Any problem? Because we have newly issued these debentures, no? So we'll have to take the issue price. They have not given any issue price. So we'll assume that these debentures are issued at par itself. Hence NP is 100 divided by N. What is N, sir? With a maturity period of 5 years. We have issued it now. It will get redeemed after 5 years. So the remaining life is what? 5. So whole thing divided by RV, which is 153.10 plus NP, which is 100 divided by 2. So calculate these for me.
9.75.
Final answer or this one?
That one.
Okay,
75. 10.62.
10.63. Okay. Huh? Okay, fine. 10.62. 126.57. 2 decimals maybe I'll take. 55. Okay, so cost of debt will be 0.1609 or 16.09 percentage. No, 16.1 number. One more problem, huh? What you do, sir? Believe. Okay, write it down. Bye, sir. Good night, it seems. Okay, if any confusion anybody has? No? Okay, that's all for today. Thank you for your time. See you tomorrow, same time. Tomorrow's class is usual time. Okay, 4:15 to 9:15. Thank you.